Today we shall be discussing company accounts. Under company accounts, we shall be discussing the following things. One is, what are the features of a company? How many types of companies are there? What is the distinction between partnership firm and a limited liability company? And what is the distinction between a partnership firm and a company? And how many classes of share capital can be issued by a company? How the issue of shares is done? What are the accounting entries in respect of shares issued at par, issued at premium, and issued at discount? And we will also talk about sweat equity shares, stock option schemes, and then forfeiture and reissue of shares. And finally, we will also discuss the issue of bonus shares and also another class of shares known as non-voting shares. So let us now start with the introduction. As you are aware, there are different types of business organizations. That means businesses can be organized in different ways, such as proprietary firms, where one person is the proprietor of the business, a partnership firm where two or more persons join together to do business, and joint stock companies. A company is defined as an association of persons who contribute money or money's worth to a common stock and uses it for a common purpose. A company is created by law, therefore it is a legal entity, just like an individual. But unlike an individual, company has no physical existence. Section 311 of the Companies Act 1956 defines a company as a company formed and registered under this act or an existing company. An existing company means a company formed and registered under any of the previous Companies Act. That means all those companies which had come into existence before the Companies Act came into practice are also defined as companies, and thereafter whatever companies are registered under the Companies Act 1956 are also treated as companies. So the main features of a company are as under. One is, it is an incorporated association. That means it has been incorporated as an association. It is an artificial person. It has got perpetual succession. That means irrespective of whether the shareholders remain the same or change, the company has continued existence. That means it has got perpetual succession. Shareholders may come and go, but the company goes on. Company has got a common seal and it has got limited liability. This is one of the most important characteristics of a company, limited liability. Then separation of management from ownership. That means the management will be different normally in case of a company than the owners. This is because owners are spread over and it is not possible for the owners, that is the shareholders, to take part in the company. So the ownership will have to perforce entrust the management of the company to a separate body known as management. Therefore, in the case of a company, there is a divorce of management from ownership. And another important characteristic of a company is transferability of shares. Shares are easily transferable from one person to another. That means shareholding can be changed at any point of time, unlike in case of a partnership firm where transfer of shares can be restricted by the partners. And the separate legal status is another characteristic of a company. It is independent of the individuals who form the company, and it has got a large membership, that is large number of shareholders who can contribute to the formation of the company. Based on different characteristics, companies can be divided into numerous categories. Based on incorporation, a company can be classified as a chartered company or a statutory company, a registered company, or a foreign company. And based on ownership, it can be a private company. That means ownership restricted to certain private individuals. A public company, ownership restricted to a large number of individuals. A government company, ownership in the hands of the government. And then a holding company, that is ownership in the hands of a parent company. Based on liability also, companies can be classified into company limited by shares, company limited by guarantee, company with unlimited liability, and a subsidiary company. In the case of companies limited by shares, share capital is issued to a number of shareholders and their liability is limited to the extent of the shares they have purchased. In the case of a guarantee limited company, that is company limited by guarantee, there is only a guarantee given by the members of the company and their liability is restricted to the amount of guarantee given by each of the members. That means there is no share capital in the case of a company limited by guarantee. Similarly, a company can also be formed with unlimited liability. Normally such companies are rare, but it can be formed also. That means the shareholders, that is the members of the company, take on unlimited liability on behalf of the company. And a subsidiary company is of course a company owned by the parent company. So parent company is called the holding company, subsidiary company is called the company owned by the holding company. Now let us try to understand the difference between a limited liability company and a partnership firm. So as you know, in the case of a partnership firm, formation it is relatively easy and it has got limited legal formalities. That means the formalities to be completed are limited in nature. In the case of a limited liability company, it is difficult and there are many legal formalities which are required to be completed. Therefore, relatively it is difficult than a partnership firm. And the matter of registration, a partnership firm need not be registered. There is no compulsion for registration of partnership firms, though of course registration of a firm gives certain added advantages to the firm. But in the case of a limited liability company, it is compulsory under law to register the company. That means it is mandatory in terms of the Companies Act 1956. As far as membership is concerned, in the case of a partnership firm, minimum can be 2. That means there should be at least 2 persons to form a partnership firm, and maximum is 10 in the case of a firm having banking business, or 20 in case the firm is doing other businesses. But in case of private limited and public limited companies, the membership limits are different. In the case of a private limited company, the minimum membership is 2 and the maximum is 50. And in the case of a public limited company, minimum is 7 and there is no maximum limit. That means any number of shareholders can become shareholders of a public limited company. And as far as liability is concerned, you know that in the case of a partnership firm, the liability is unlimited. That means the partners are liable to the dues owned by the firm to the extent of the entire dues, irrespective of the capital brought in by them. Whereas in the case of a limited company, they are limited to the face value of the shares held by them. And that means the personal properties of the members cannot be attached on account of the liabilities of the company. And as far as ownership and management is concerned, normally in the case of a partnership firm, the partners themselves manage, they are also the owners. So there is no distinction between ownership and management in the case of a partnership firm. Whereas normally in the case of a company, there is separation of ownership and management. Management will be different from the members, that is the shareholders. And as far as existence is concerned, in the case of a partnership firm, it has no perpetual existence. That means it will come to an end on the death of the partners, or by mutual consent they can decide to end the partnership firm. Whereas in the case of a limited liability company, it enjoys perpetual existence. That means irrespective of the changes in the shareholders or the members of the company, it will continue to be in existence. As far as transfer of shares is concerned, it is difficult in the case of partnership firms, because without the consent of partners, shares cannot be transferred. Whereas in the case of a company, this is one of the most important features of a company, that the shares are freely transferable. As far as government control is concerned, it is very limited in the case of a partnership firm, but relatively more in the case of a limited liability company, because a liability company is required to fulfill a lot of formalities in terms of submission of financial data, in terms of providing information to the registrar of companies and so on. Now let us try to understand what are the different classes of capital, share capital, which can be issued by a company. Share capital can be of 2 kinds. One is known as equity capital, the other is known as preference capital. And let us take the second one first, that is preference capital. It is also called preference shares. Preference shares can be further classified into 2 categories. One is cumulative and non-cumulative, or they can be classified into redeemable and non-redeemable, or they can also be classified into participating and non-participating shares. What is the meaning of cumulative preference shares? Cumulative preference share means whenever dividend is not declared on preference shareholders, because the company has not made profits, then the shares get accumulated and they have to be given in the next year or in the year in which the company earns sufficient profits. They are called cumulative preference shares. In the case of non-cumulative preference shares, if a company does not make profits in a particular year, the shareholders will not get any dividend, but otherwise, whenever a company makes profits, company is bound to declare dividends to the preference shareholders at the rate agreed upon at the time of issue of the preference shares. In the case of redeemable preference shares, these are redeemed at the end of a particular period, normally let us say 20 years. So at the end of 20 years, the preference shareholders will get back their money. Whereas in the case of non-redeemable preference shares, they will continue on the books of the entity for perpetuity. That means they cannot be redeemed. And participating preference shares means the preference shareholders can get voting rights. That means they can participate in the management of the company, whereas non-participating preference shareholders means they do not have a right to vote in the meeting. That means they are not party to the management of the company. And share capital also can be classified in different ways as authorized capital, issued capital, subscribed capital, called up capital and paid up capital. So these terms are very important to understand. Authorized capital is a capital authorized by the articles of association of the company. That means it is the amount up to which the company can raise capital. It cannot raise capital beyond the authorized capital. In case it wants to raise more capital, first it has to amend the articles of association of the company and then they can issue the extra capital required. Whereas issued capital is the capital actually issued to the shareholders. That means it will always be less than or equal to the authorized capital. And subscribed capital is the capital which is actually subscribed to by the shareholders. That means it will be either equal to the issued capital or less than the issued capital. Similarly, called up capital is capital which has been called up. That means the company has asked the shareholders to pay that money. So normally called up capital will be less than or equal to the subscribed capital. Similarly, paid up capital is the capital which is actually paid by the shareholders to the company. So paid up capital can be equal to or less than the called up capital. So normally what is shown in the balance sheet of a company is the paid up capital, that is the capital which has actually been received by the company on its books. And how the shares are issued, let us try to understand, and then we will have to talk about the accounting entry which need to be passed in the case of issue of shares. As we know, the company raises capital through the primary capital market. This is what we call the initial public offering, and prospective shareholders subscribe to these shares. If the company receives applications of large number of shares then offered, the company can allot only the offered number based on a type of allotment called norms of allotment. That means, let us say a company has offered shares of 1 lakh shares of rupees 10 each, but if they receive applications for, let us say, 1,50,000 shares, obviously the company cannot offer more than 1 lakh shares. So there they have to follow a certain procedure for allotting only 1 lakh shares to all the applicants of 1,50,000 shares. So this basis of allotment is finalized by the merchant banker, that is the banker who has assisted the company in raising the capital, and the concerned regional stock exchange where the shares are likely to be listed, and then the registrars to the issue based on the following guidelines. So there are certain guidelines laid down by the regulator of the capital market, that is SEBI, that is Securities Exchange Board of India. According to this, applicants are required to be categorized according to the number of shares applied for. That means those who have applied for less number of shares and larger number of shares. The total number of shares to be allotted to each category shall be on a proportionate basis. So depending on the category, it has to be on a proportionate basis. Similarly, calls on shares are normally in the following fashion. The certain amount with application. Normally, whenever a company goes in for raising of capital, it asks the shareholders to send certain amount along with the application. That is called call along with the application, and certain amount on allotment. Once the shares are allotted to a particular member, he is required to pay a certain amount, and thereafter balance on call. That means the balance amount can be received by the company from the shareholders in installments. It can be only 1 call or 2 calls. So in such cases they are called first call, second call, and so on. So now let us try to understand the accounting entries in respect of issue of shares. As we know, shares can be issued at par, at premium, or at a discount. Issue of shares at par means if the face value of the share is 10 rupees, they are issued to the shareholder also at 10 rupees only. And if it is issued at a premium, it means if the face value of the share is 10 rupees, it is issued at a price which is bigger than the face value, that is more than 10 rupees. Let us say if it is issued at 12 rupees, then we can say the shares have been issued at a premium and premium amount is considered to be 2 rupees over the face value. If it is issued at a discount, then it is said that the price to be paid by the shareholders is less than the face value. For example, if a share which has got a face value of 10 rupees is issued at 8 rupees, then it is said to be issued at a discount of 2 rupees to the face value. Let us now first understand the accounting entries which have to be put through in the case of shares which are issued at par. So there are different stages when the money is received by the company. So based on different stages, we will have to account for entries. First stage of course is receipt of application money. Along with the applications, money is also sent by the prospective shareholders. So this money is credited to the bank account. So you have to debit bank account and credit to an account called share application account. This is the total amount of money received on application of shares by the prospective shareholders. And if there is no oversubscription, that means the number of applications received is the same as the number to be allotted, then an allotment, this entire share application money account is debited and it is transferred to share capital account. That means as soon as the allotment takes place, the money goes into the share capital account. So share capital account is credited and whatever new account we had opened as share application account gets closed by debiting the amount to share application account. That means whatever entry you had passed earlier gets reversed. But however, if there is oversubscription, that means the money received is much more than what they are supposed to retain, then allotment is to be done proportionately. In that case, what is to be done? Share application account has to be debited for the full amount. That means the entire transaction has to be reversed and a part of it only goes to share capital account because the company can accept only certain number of applications or only proportionate amount. That is what we call the accepted application. To the extent of the money which can be retained by the company as share capital will be credited to share capital account and the rest is credited to bank account, that is in terms of rejected applications. So what happens? Crediting to bank account means the money is returned to the shareholders whose applications have been rejected. The amount due on allotment, so whatever the money has to be paid on allotment again has to be passed. So we have to pass an entry by crediting the amount to share allotment accounts. This amount also is taken from that amount, or we can also pass entries as share application account debit to share capital account based on the allotted numbers, to bank account, that is the excess amount received, and to share allotment account, it is amount due on allotment also is credited to that account. So even if the money is not received, because the money is to be received only after the allotment is received by the applicant and they are given some time to pay that money. So even before that, the money is kept in the share allotment account, that is the amount due on allotment. So when the next installment is received from the shareholders, that is the allotment due, there is a separate date fixed for receiving the allotment money. On that date, that share allotment account which has been created will be reversed by debiting that account and the amount gets transferred to share capital account. So when money is received actually, then we have to debit bank account for the money received on allotment and it is credited to share allotment account. Similarly, when the first call is made, then we have to credit share capital account with the extent of the amount of money to be received by debiting the share first call account. So even before the money is received, we raise an entry and credit the share capital account. So the entry is share first call account debit and to share capital account. And when the actual money is received on calls, that time we have to reverse the share first call account by crediting that account and debiting the bank account where the money received is credited. So normally here there could be complications. The calls are made, but all the shareholders may not pay the money. Some may decide not to pay the money at all, in which case the money which is expected to be received may not be received in full. So in such cases, they are to be transferred to call in arrears account. So there what we pass is call in arrears account is debited, and then we credit it to share first call account and also share second call account. Whenever the second call is also made, there could also be arrears. So all these monies have to be kept in the call in arrears account, and at a later date, after sufficient time is given and notice is given to the shareholders to pay the money, if they don't pay the money, then they will be forfeiting the shares. The accounting entries for this forfeiture of shares we will see at a later date when we take up forfeiture of shares. Now let us try to understand the accounting entries in respect of issue of shares at a premium. Here what it means is the amount received is more than the face value of the shares. Therefore, we need to pass certain entries in order to take care of the extra money which is being received by the company as premium. The Companies Act, of course, does not prohibit issue of shares at a premium. That means Companies Act allows issue of shares at a premium. Only thing is, this has to be disclosed to the investors, and the amount of premium has to be decided by the company itself. SEBI does not have any role in deciding the premium to be fixed by the company. But however, the company is required to follow all the guidelines laid down by SEBI in the matter of disclosure to the investing public. And the premium amount which they collect, it can be utilized only for certain purposes. They are, one is buyback of shares, issue of fully paid up bonus shares, and writing off of preliminary expenses and discount and commission on issue of shares and debentures, or paying premium on redemption of preference shares debentures. For all these purposes, whatever premium is collected on the issue of shares at a premium can be used. And as regards the entries are concerned, so share premium amount is classified as a liability under the head reserve and surplus. So it will not go to the share capital account. Only the face value of the shares will go to the share capital account. The excess premium collected will go to the share premium account, which will be part of the reserve and surplus under the liability side of the balance sheet. So the journal entries, as and when the applications are received, is share application allotment account debit, and to share capital account and to share premium account. That means if it is issued, let us say at 12 rupees, face value being 10, for each share 10 rupees will go to the share capital account and 2 rupees will go to the share premium account, whereas the entire 12 rupees received from the company will be debited to the share application or allotment account. And in the case of issue of shares at a discount, that means the money received is less, in which case it will be less than the share capital. So there what we have to do is that 2 rupees discount, whatever is the discount, is treated as an expenditure in the books of the entity. Therefore, whenever money is received, we can credit only so much of the money which is received, that is share allotment account will be debited with only 8 rupees. If let us say a share is issued at 8 rupees and the remaining 2 rupees, which is the discount offered on the share, is debited to the discount account. It is called discount on issue of shares account, and the share capital is credited with the entire 10 rupees. So there will be debit of 8 rupees to the share allotment account, debit of 2 rupees to the discount on issue of shares account, and then credit of 10 rupees to the share capital account. But however, there are certain guidelines have to be followed if the shares have to be issued at a discount. First of all, issue of shares at a discount has to be authorized by the members in the general meeting. That means all the shareholders have to approve this in a general meeting. And then in addition to that, the company has to get sanction from the company law board called CLB. This is mandatory in nature, and discount also cannot exceed 10% of the face value of shares. So if the face value of shares is 10, discount offered cannot be more than 1 rupees, and shares must be issued within 2 months from the date of sanction of CLB. That means within 2 months of the date of sanction of CLB, the company has to come out with the share issue. and company cannot issue discount shares at a discount within 1 year from the date it commences business. That means newly formed companies are not allowed to issue shares at a discount within the first year of their existence. Now we shall talk about issue of sweat equity shares. As you know, sweat equity shares means equity shares issued by the company to employees or directors at a discount or for consideration other than cash. That means this is an incentive given to the employees by the company in the form of shares. So this issue has to be authorized by a special resolution passed in the general meeting. That means if the company approves this in the general meeting, then sweat equity can be issued to the employees or directors or both of them at a discount or for any consideration other than cash. Similarly, we have what is known as employee stock option scheme called ESOS. ESOS means a scheme under which the company grants an option to an employee to apply for shares of the company at a predetermined price. This price is determined by the company. Normally it will be less than the market value, and the employees are offered this. Employees are free to accept or reject this offer, and if they accept, they will be getting shares at a price much less than the market price. This right has to be exercised by the employee during a specified period. Normally a few months are given for the employees to exercise this right. Separate guidelines have been issued by SEBI, that is Securities Exchange Board of India, for issue of shares under this scheme. We will not be going into the details of this scheme at this stage. Now we will talk something about forfeiture and reissue of shares. As I said, whenever shares are allotted, the company may be making further calls on shares to receive the entire amount of money to be received under the shares, and while the calls are made or when the allotment is made, if some of the shareholders do not pay the money within the stipulated time, then they will forfeit such a, that means their shares will be cancelled and the money which they have already paid will not be refunded to them. That money will lie with the company only. So in such cases, companies are required to pass certain entries in their books to take care of the forfeiture of shares, and such forfeited shares can at a later date be further issued to some other shareholders. So that is also possible. So when a shareholder defaults in paying up dues on calls, the company can forfeit such shares by passing a resolution in the board. This resolution is mandatory. That means forfeiture can be done only after the board of directors passes a resolution on forfeiture of shares, and on such cases we need to pass different journal entries in the books of the company. So the first entry will be, we have to debit the share capital account. That means that share capital has to be reduced to the extent of the face value of the forfeited shares. And since the company has already received some money, that money will be transferred to an account called forfeited shares account. So that forfeited shares account will be credited, and the remaining amount which the company was to have received, which was kept in calls in arrears account, that account will be credited. Therefore, by debiting share capital account, two accounts will be credited, that is the calls and arrears account, that is the amount unpaid by the shareholder, and forfeited share account, that is the amount already paid. Let us illustrate this with the help of an example. Let us say the company issued shares of face value of 100 rupees and the applicant has paid an amount of 50 rupees on application and allotment, and after that call of 50 rupees was made which he did not pay. Let us say he had applied for 100 shares, that means he had paid 15 to 100, that is 5,000 rupees at the time of application, and the remaining 50 which you should have paid on 100 shares, that is 5,000 rupees, was kept in the calls in arrears account, and the share capital account was created with the entire amount of 10,000 rupees, that is 100 rupees into 100 shares. Now the entire share capital has to be reversed because this person has forfeited his total 100 shares. So share capital account will be debited with the entire amount of 10,000 rupees, and calls in arrears account which had a balance of 5,000 will be created to close that account, and 5,000 rupees which the company has received earlier from the shareholder will go to the forfeited account. So that forfeited shares account will be credited with an amount of 5,000 rupees. And these forfeited shares, that is the 100 shares, can be reissued by the company at any time. So when the company issues fresh shares, then bank account will be debited with the amount of money received on the issue of fresh shares, and forfeited shares account will also be debited with the amount lying in the balance. The remaining, and this will be credited to first share capital account and then to capital reserve account. That means whatever money is there received from the new shares issue will go to share capital account, and the excess will go to the capital reserve account. The amount to be credited to capital reserve account is the excess of forfeited amount plus fresh issue amount and the face value of the share. For example, let us carry forward the same example which we considered earlier. The forfeited shares account has got a credit balance of 5,000 rupees. Let us say these 100 shares are issued again at a value of, let us say, 80 rupees per share. That means on 100 shares the company receives 8,000 rupees. Company already has got 5,000 rupees in the forfeited shares account. So the total amount the company has now is 13,000 rupees. The share capital account can only be credited with 10,000 rupees. So the bank account, they are receiving 8,000 rupees from the new shareholders. Forfeited share account debit will be 5,000. So total debit will be 8,000 plus 5,000, whereas share capital account will be credited with 10,000, and the remaining amount, that is 3,000, will go to the capital reserve account. So therefore capital reserve account is the forfeited amount plus fresh issue amount minus the face value of the share. That is how it has to be calculated.